Credit Comeback, 20 Powerful Steps to Skyrocket. Your Score and Unlock Financial Freedom. Chapter 1. The Secret Power of Your Credit Score. Your credit score is more than just a number. It's a gateway to financial opportunities or setbacks. A high score means lower interest rates, better loan terms, and even higher chances of job approvals. Understanding this is the first step toward taking control of your financial future. The elements making up your credit score include payment history, credit utilization, length of credit history, new credit inquiries, and credit mix. Knowing how each factor contributes will help you understand where to focus for the most significant improvements. Even small adjustments in these areas can lead to noticeable increases in your score. To begin, find out your score from one of the major credit bureaus. This baseline will allow you to track your progress as you implement each chapter's steps. Remember, the journey to a higher score begins with understanding your current standing. Chapter 2. Uncovering Hidden Secrets in Your Credit Report. Your credit report holds the keys to understanding why your score is where it is today. It includes details of your credit history, from credit card balances to loan accounts and payment history. Reviewing this report is essential for identifying areas that need improvement. Many people overlook their credit report, missing errors or outdated information that could be negatively impacting their score. Errors like incorrect account balances, duplicate listings, or outdated information are more common than you'd think. These can lead to a lower score if left unaddressed. Access your free annual credit report from sites like annualcreditreport.com. Take the time to review every account, balance, and payment history item. Understanding what's on your report is the first step toward repairing any damage. Chapter 3. Spotting and Correcting. Costly errors. Errors in your credit report can be harmful, but the good news is they're fixable. You might find inaccuracies like accounts that don't belong to you, incorrect balances, or even outdated delinquent payments. Any of these errors can significantly affect your score. If you spot an error, take immediate action to correct it. Document the mistake and gather any supporting information. Send a dispute letter to the credit bureau, including all relevant details for why the information should be corrected. Be prepared to follow up, as credit bureaus have 30 days to investigate your claim. Ensuring these errors are removed can provide an instant boost to your credit score and open doors to better financial opportunities. Chapter 4. Winning the Dispute Game with Credit Bureaus. When disputing errors, a strong case is essential. Start by gathering supporting documents like bank statements or letters from lenders. Craft a detailed dispute letter explaining the error, why it's incorrect, and what you want to see fixed. Send your dispute to each credit bureau reporting the error, as some mistakes might only appear on one report. Using certified mail will ensure you have proof of your dispute request. Once submitted, credit bureaus typically have 30 days to investigate and respond. Follow up to confirm the issue is resolved. A successful dispute can have a fast, positive impact on your score. Chapter 5. Mastering Late Payments and Getting Back on Track. Late payments are one of the biggest factors affecting your credit score. Every late payment can stay on your report for up to 7 years, making it crucial to prioritize on-time payments. Even a single missed payment can lower your score, so getting a handle on this is key. To avoid missed payments, set up automatic payments or reminders. Prioritizing essentials like your mortgage, car payment, and credit cards will help establish a steady payment history. Consistency here can lead to noticeable improvements in your score. If you have a history of late payments, consider negotiating with your creditors. Some lenders may be willing to remove the negative marks if you've since improved your payment habits, giving your score a quick boost. Chapter 6. The Right Way to Tackle. Collections accounts. In collections can drastically lower your score and signal financial instability. If you have a collection account, prioritize settling it to show future lenders that you're proactive about your debts. Ignoring collection accounts will only lead to more issues. Begin by negotiating with the collection agency. You may be able to arrange a payment plan or settle for less than the total owed. Be sure to request a pay-for-delete agreement. which means they'll remove the collection from your report after payment. Once settled, follow up to ensure the account is marked as paid or removed. This action alone can add valuable points to your score and help rebuild your financial reputation. Chapter 7. Slashing high balances for fast results. High credit card balances can weigh down your credit score, especially if your credit utilization rate is high. This rate measures how much credit you're using compared to your total available limit, and experts recommend keeping it below 30%. Prioritize paying down high-interest credit cards to lower your utilization rate. Start with the card carrying the highest balance or interest rate, and make steady extra payments when possible. Reducing your balances over time will gradually improve your score. As you pay down balances, avoid closing accounts. Keeping accounts open with zero balances can help lower your utilization rate, positively impacting your score. Chapter 8. Unlocking the secrets of credit. Credit utilization is one of the most influential factors in determining your credit score. A low utilization rate shows lenders you're not over-relying on credit. Aim to keep your utilization under 30%, but the lower, the better. Spread your spending across multiple cards rather than maxing out one account. This can help you keep individual utilization rates low and improve your overall credit health. If possible, ask your credit card issuers for a credit limit increase. By raising your available credit, your utilization rate will drop without any additional effort. Chapter 9. Building a positive payment history. A consistent payment history is essential for a strong credit score. Lenders prioritize borrowers who reliably pay on time, as it suggests financial responsibility and stability. Automatic payments are a great way to prevent missed payments. If you struggle with budgeting, consider setting aside a portion of each paycheck specifically for debt repayment. Over time, these payments will establish a history of reliability. In addition, maintaining a low balance on each card further demonstrates responsible usage. By focusing on consistent payments, you're actively laying the groundwork for a stronger credit score. Chapter 10. Creating a budget to stay on track. Budgeting is essential to managing debt and avoiding late payments. A budget keeps you organized and helps ensure you have funds available for necessary expenses, including debt repayment. Start by categorizing your income and expenses. Identify non-essential spending and consider reallocating that money toward debt payments. Having a budget in place will prevent overspending and help you prioritize bills over unnecessary purchases. Stick to your budget and review it monthly to track your progress. Maintaining control over your finances will positively affect your credit score as you reduce balances and keep payments current. Chapter 11. The Art of Responsible Credit Use. Using credit responsibly is crucial for maintaining a good credit score. This means only borrowing what you can afford to repay and avoiding unnecessary debt. Understand the difference between using credit for convenience and relying on it as a source of funds. When you use credit cards, aim to pay off the balance in full each month. This habit not only prevents interest charges but also demonstrates to creditors that you are a responsible borrower. If you must carry a balance, make a plan to pay it off as quickly as possible. Also, remember that opening too many credit accounts at once can negatively impact your score. Each new account results in a hard inquiry, which can slightly lower your score. Instead, be strategic about when and how you apply for credit. Chapter 12. Understanding new credit. New credit inquiries occur when you apply for a new credit card or loan. While a few inquiries won't have a significant impact, multiple inquiries within a short period can signal to lenders that you may be a riskier borrower. It's wise to limit applications for new credit to only when necessary. Before applying, check your credit report to ensure you're in good standing. This way, you'll know if you have a good chance of being approved, which helps avoid unnecessary inquiries. If you're rate shopping for loans, such as a mortgage or auto loan, do so within a short time frame, typically 14 to 45 days. Most credit scoring models treat multiple inquiries for the same type of loan as a single inquiry, minimizing the impact on your score. Chapter 13. Diversifying your credit mix. Having a variety of credit accounts, such as credit cards, a mortgage, and installment loans, can benefit your credit score. Credit scoring models look favorably on borrowers who manage different types of credit responsibly. If you only have credit cards, consider adding a small installment loan, like a personal loan or an auto loan, to diversify your credit mix. Just be sure that you can manage the payments and won't take on more debt than you can handle. However, avoid opening new accounts solely for the sake of diversifying. Each new account can initially lower your score due to hard inquiries. Focus on responsible management of existing accounts first, then consider adding new ones as needed. Chapter 14: The Power of Credit Education. Understanding the ins and outs of credit is essential for maintaining a strong score. Educating yourself about credit terms, how scoring models work, and strategies for improvement can empower you to make informed decisions. Utilize free resources available online, such as financial education websites and consumer protection agencies. Many credit card companies also provide educational materials and tools to help you monitor your credit and understand its components. Consider enrolling in financial literacy courses offered through local community colleges or online platforms. The more you learn about managing credit, the better equipped you'll be to maintain a healthy credit profile. Chapter 15: The Benefits of Credit Monitoring Services. Credit monitoring services can be valuable tools for keeping track of your credit score and report. These services alert you to changes in your credit report, such as new inquiries or significant balance changes, allowing you to take immediate action if necessary. Many credit card companies offer free credit score monitoring as a part of their services. Take advantage of these features to stay informed about your credit status and any potential issues. By regularly checking your credit, you can spot errors or fraudulent activity early, minimizing their impact on your score. Proactive monitoring helps you stay in control of your credit health. Chapter 16: Building Credit with Secured Credit Cards. If you're struggling to qualify for traditional credit cards, a secured credit card may be the solution. These cards require a cash deposit that acts as your credit limit, reducing the risk for lenders. They can be an excellent way to build or rebuild your credit. When using a secured card, treat it like a regular credit card. Make small purchases and pay off the balance in full each month. This behavior helps establish a positive payment history while keeping your utilization low. After demonstrating responsible usage for several months, consider requesting a conversion to an unsecured card or a credit limit increase. This transition can help further improve your credit score. Chapter 17: Taking Advantage of Authorized User Status. Becoming an authorized user on someone else's credit card can help you build your credit history. This arrangement allows you to use their card while benefiting from their positive payment history, potentially boosting your score. Choose a responsible borrower with a good payment history and low credit utilization to maximize the benefits. Before agreeing, discuss how the card will be used and the expectations for payment to avoid any misunderstandings. Remember that any missed payments or high balances on the primary cardholder's account can negatively affect your credit score as well. Monitor the account regularly to ensure it remains in good standing. Chapter 18: The Importance of Patience and Persistence. Improving your credit score takes time, patience, and consistent effort. Many of the strategies outlined in this book will not yield overnight results. It's essential to remain committed to the process and track your progress regularly. Celebrate small victories along the way, such as correcting errors, paying down a balance, or achieving a specific score increase. These milestones will keep you motivated to continue your journey. Remember, building good credit is a marathon, not a sprint. With each positive action you take, you're investing in your financial future. Chapter 19: Planning for Long-Term Credit. Health. After improving your credit score, maintaining it should be your next focus. This includes continuing to make on-time payments, keeping credit utilization low, and regularly reviewing your credit report for errors or changes. Set up reminders for bill payments and maintain a budget to keep your finances on track. Long-term planning will help ensure your score remains high, giving you access to better financial opportunities. Consider setting future credit goals such as purchasing a home or financing a vehicle. Having clear goals will keep you motivated to maintain your credit health over the years. Chapter 20. Embracing financial freedom. With a solid credit score comes financial freedom. Improved credit opens doors to better loan terms, lower interest rates, and opportunities that may have once seemed out of reach. As you apply the lessons learned in this book, you'll find yourself in a stronger financial position. Use your knowledge to not only maintain your credit, but also educate others. Share your journey and insights with friends and family, helping them avoid common pitfalls and empowering them to improve their credit. Finally, remember that financial wellness is an ongoing journey. Keep learning and adapting your strategies to ensure a bright financial future and enjoy the opportunities that a great credit score provides. Conclusion: your journey to credit mastery. Repairing and improving your credit is a journey that requires effort, dedication, and knowledge. By following the steps outlined in this book, you can take control of your credit and set yourself up for a successful financial future. Remember that every small step counts and that with patience and persistence, you can achieve the credit score you desire.